So you can go ahead and accept that. Okay, good. And let's go ahead and jump ourselves into, and we are going to get into chapter 5 today, but before we do that, there was a little bit of chapter 5 left that I think it's worthwhile for us to cover together. And then I'll show you some of the things specifically that we'll be looking at in chapter chapter 6 in a little while when we get to that. But let's go ahead and finish up a couple of things that we had left off from chapter 5, which I don't think are heavy point value items, but nonetheless, something that maybe is a little more, I don't know, should I use the word convoluted, a little more complex than some other areas. And so I think it's worth it if I can show you a couple tips on how those things work, starting with this troubled debt restructuring. Okay, now what happens? A company borrows money and they're in a situation where they're not able to pay back that money that they owe. And it's going to be principal and interest that they're maybe not able to pay. Well, a couple of things can happen. One, the creditor may go ahead and take some asset back in exchange for whatever money is owed to them. Well, if that's the case, there's going to be recognition of a gain by the debtor. Okay, and people say to me, how do you know it's a gain, John? Well, I know it's a gain because if they could pay off at least what they owe, then there would be no gain, right? But the fact that they're not able to pay off what they owe at that point, then whatever the creditor is accepting from the debtor in exchange is going to be a gain. To the creditor, of course, there would be a loss because they're going to be writing off a receivable for something that is of less value than whatever the outstanding balance was on the loan. Now, that's one possibility. The other possibility is, well, another possibility is we could take back stock. We'll talk about that very briefly, but that's not really as much do I see in the questions. The other potential is that there will be a modification of terms. The modification in terms, I'm going to say, well, look, I want to get something back from you, so I'll forgive a portion of the debt, or I'll lower the interest rate on the debt, something like that. Well, if that's the case, then again, that's going to be a gain to the debtor in some cases, and it will be a loss in all cases to the creditor when that happens. So those are the couple of things that we're going to be taking a look at, and we go ahead and we start talking about how we're going to have an accounting by the debtors first. This is the person that owes the money, and there could be a transfer of an asset. Now, there's going to be 2 steps to this potentially, and the reason there's 2 steps potentially is we want to maybe report the loss from the transaction of getting rid of the property separately from the gain or loss from the transaction of getting rid of the property separately from what will always be a gain for the ability to not have to pay the entire amount, the carrying amount of this debt. So step 1, if you will, if you want to call it steps, okay, step 1 would be to sit here and say, well, what's the fair value of the asset transferred versus the book value of the asset transferred? So we're going to look at an example in a minute where they're going to be transferring land. You look at the difference between the fair value of the land and the book value of the land, and depending on whether the fair value is more or less, then the book value could be a gain, could be a loss. Then step 2 will be to say, well, whatever the fair value of that asset that was transferred, say the land, versus the carrying amount of the payable, that includes both principal and interest, that difference, and guys, that will always be a gain. Okay. Now, you could also transfer stock, transfer an equity interest, and if that's the case, then there is simply the difference between the carrying amount of the payable, again, both principal and interest, versus the fair value of whatever the equity is that's being transferred. Okay, now we're going to look at a numeric example of that here in a couple seconds, but let's also look at what can happen if there is a modification of the terms. Now, if there's a modification of the terms, A restructuring that does not involve the transfer of asset or equity will involve modification of terms. In a modification, the debtor usually accounts for the effects of the restructuring prospectively. The debtor does not change the carrying amount unless the carrying amount exceeds the total future cash payments specified by the new terms. Now, what's interesting here, when we say total future cash flows, I want you to put in no discounting. So let's say you owe me $1 million and you come to me, you say, John, I can't pay the $1 million. And you and I go back and forth and we negotiate for some time. And finally, we agree that you're going to pay me $1 a year for the next 1 million years. Is the total payments going to equal the carrying amount of that debt? Yes, although on a present value basis for 1 million years, probably the present value of that is what? 0. But FASB looked at that some years back and said, well, yeah, but if we have the debtors discount the cash flows in that scenario, then we're going to have what? Debtors who are in trouble, who are needing a modification of terms, booking huge gains on their financial statements. Is that really the kind of information we want in the hands of investors and creditors who we're supposed to be looking out for when we establish accounting standards? No. So they said you simply look at all the future cash flows that are going to come from this, and as long as those future cash flows are greater than or equal to the carrying value of the debt, there's going to be no gain recognized by the creditor for a by the debtor for a modification of terms. Now, notice conversely, they come down here and they tell us that if the total future cash flows are both the principal and interest at the time restructuring continues to be payable for the new terms, and that's not what I wanted to highlight right here. Sorry, guys, I highlighted the wrong thing right here. Future payments, look at this. When total undiscounted future payments are less than the carrying amount, the debtor should reduce the carrying amount accordingly and recognize the difference as a gain. So now, if we looked at that situation and you're going to pay me $500,000, let's say, on an undiscounted basis, and the carrying amount is $1 million, you're going to pay me $600,000, whatever, then what? Then the gain that you would recognize would be $400,000. But again, do not discount the cash flows on the debtor side. Now, this gets a little bit confusing sometimes because there's an uneven treatment between the debtor and the creditor. And when I mentioned the FASB, I was on an assignment long time ago with the GAO when we were looking at standard setting. We were trying to understand why FASB did certain things that didn't seem to hold up from a theoretical standpoint. And this was one of the standards we looked at that time, because we were saying, well, why would you ask the debtors to do one thing and the creditors to do the other? And we sat with the former chairman of the FASB at that time. I forget the person's name, Donald Kirkland, I think. He was teaching. He was a professor at that point at New York University. So we went over there and met with him and sat with him. I mean, the answer he gave us is because it was kind of interesting, because I asked the question, he kind of looked at me like, because dummy, we don't want debtors to be booking these huge gains. So it's okay, we don't make the debtors discount, we will make the creditors discount so that their losses will be more than what the debtor's gains are. So even though you have two different treatments on two different sides of that equation, FASB felt that that was better than having debtors booking these huge gains. So when you take a look, modification of terms, use present value, impairment should be measured based on the loan's present value of expected future cash flows, discounted. And this part was something that was dissented by some members of the FASB, using the loan's historical effective interest rate. Go ahead and flashcard that, but there were some FASB members that felt the new modified interest rate associated with that loan should potentially be used as opposed to the historical rate, but the people that were in favor of the historical rate won on that. Okay. Now, once you have that impairment, you will debit bad debt expense and credit the allowance for the amount of that impairment that you have calculated by discounting the cash flows. Now, when you look at that from a purely theoretical standpoint, guys, I understand that it is like, what are we talking about here? So fortunately, we have some pretty good examples. And I think when you see the examples here, you'll be like, oh, okay, I got this. I understand what we're doing. Okay. So let's look at transfer of an asset. And let's just read through the facts here of this question, because we're going to use them here a couple times. But Hull Company is indebted to Apex under 500,000, 12%, 3-year note dated December 31st, year 1. Because of Hull's financial difficulties developing in year 3, Hull owed accrued interest of 60,000 at December 31st, year 3. Under a troubled debt restructuring on December 31st, year 3, Apex agreed to settle the note and accrued interest for a tract of land having fair value of 450. Hull's acquisition cost was 360. And then the problem says, hey, calculate the gain recognized by Hull on the troubled debt restructuring, prepare the journal entry, and prepare the journal entry to record the transaction on Apex, which is the creditor. And we're going to see how we're going to treat that after we look at the example here for the debtor first. So Hull is the debtor. The debt is 500,000 face value plus 60,000 accrued interest. So the debt forgiven is 560. The carrying value of the asset is what? Is 360. That's what they had purchased this land for. So a question could ask you, total gain on that is 200,000. Now, I don't know that Becker has to, say per below. It didn't have to be per below. You could just simply say what the debt forgiven was carrying value 560. The carrying value of the asset was 360. The total gain on this is 200,000. I don't know why they have to say per below, but if you wanted to break out the gain, okay, you could do that, because maybe an entity thinks that this gain on the restructuring is significant enough that they want to show it as a separate line item or something on the financial statements, and the portion related to the gain on the holding gain of the land versus that of the forgiveness of the debt. And if they wanted to break those out into separate amounts, they might do something like this. But the answer to this question is given right here if they ask the total gain. I don't know about per below, but let's just go ahead and let's take a look at how we break out the gain. And they tell us that the gain on the disposal of land, just like it is any asset, is the difference between the fair value and the acquisition historical cost, the book value. Okay, if it was a building, it'd be what? It'd be the original cost minus any accumulated depreciation up at that point. Okay, but that will be the holding gain on the asset that's transferred. And then we would do what? We would take that fair value of the land, which again, they say per above, but it was given to us right here. The land was worth 450. We bought it for what? For 360. So we're going to say what? The amount that was owed was the 560 that they told us versus what? Versus the fair value of the land, which was 450. So the gain on the restructuring is 110. So the total gain is the difference between what? The book value of the asset surrendered and the book value of the debt. The gain on the actual restructuring is the difference between the amount of debt and whatever the fair value of the item was that was restructured. And then, of course, if you add in the gain from the disposal of the land, that would get you up to the total. Question. Okay, I'm thinking right here is more where they would ask, but if they do ask you to separate them out somehow, then yeah, you would have to do this thing. Okay, good. Yeah, I guess it's worth looking at this journal entry real quick. I don't think I'm going to ask you for journal entries on this, but you would do what? You would debit the note payable, debit the interest payable, credit the land for the 360. And again, notice, guys, they broke out the gains separately, but those gains are reported what? They're going to be reported as non-operating items on the income statement, but I guess If the entity decided they wanted to call those two amounts separately, then we'd need two separate accounts for that. I don't know why they wouldn't just simply put one number gain from, restructuring of debt and put the whole 200,000. FASB doesn't come out and get up in your face and say, you must separate these two amounts out. So I'm not sure why we're going through all that. Well, I know why they're going through this trouble in case the CPA exam asks you to separate them out. In the olden days, this was important because it used to say that a gain on the restructuring portion was something called extraordinary. And extraordinary items absolutely had to be reported out separately, but they got rid of that some years later. So this separating out the gain on the restructuring versus the gain on the disposal of the land is somewhat old hat now. Okay. Okay, good. Now you come over, and I'm not going to do the equity one at this point in time. Oh, what is this? This is for the apex. Okay, this is the creditor. Creditor is going to debit the land at fair value, debit the allowance, and of course they are assuming here that there's enough in the allowance to absorb that loss. So, the fact that they're just debiting the allowance for credit loss, if you have a situation like this, you may need to take a look at the allowance and see if more needs to be put in the allowance for this. And if so, you would have debited bad debt expense and credited the allowance, and then you could have taken the write-off here the way they showed here. And they go ahead and write off the receivables for the note and the interest. I'm not going to go into transfer of equity, guys. It's the difference between the fair value of the equity, whatever it's trading at, and the book value of the payable. That difference is a gain. Okay. Now you come over, and to me, more interesting here is the way the modification of the terms work, because we're going to get a chance to see the difference between the accounting for the creditor versus the debtor, and the big difference being that the debtor is not going to discount, the creditor is. Okay, so let's take a look. The facts from the previous example, except now they agreed to modify the terms. The accrued interest was forgiven. The interest rate was lowered to 3%. What was it? 6% before, I guess, and they lowered it to 3%, and the maturity date was extended to December 31st, year 5. And so now you take a look, and we first have to figure out, well, what's the debt that is being forgiven, and it's going to be what? It's going to be this year 4 interest, this year 5 interest. So the total is 530 is the total that they're going to be receiving, I should say. The carrying amount of the debt is what? 560 per the information. 530 versus 560 is a gain on restructuring of 30,000. No discounting of the cash flows. Treating every dollar, these dollars that they're not going to get until years 4 and 5 are being treated as though they are what? Being received today, aren't they? Okay, so we go ahead. We have the gain on the restructuring. We'll debit the note payable, credit the interest payable. We go ahead and credit the note payable for what it is they're going to be receiving. And then there's a gain on restructuring the 30,000, the difference between the carrying amount of the debt and the on an undiscounted basis, the amount, the future cash flows that are coming in. Question. Now, if you are the creditor, okay, who's apex in this, now you're going to do something a little different. You're going to be sitting there and you're going to say, well, 560 is the debt I'm restructuring, but the present value of what's going to be coming is only 423,950. So I have a loss of 136. And they're going to debit the bad debt expense and credit the allowance for that loss. But where do they come up with the 423,950? That's what's interesting here to me, is that when they come up and they look at that 423,950, they do what? They say, well, the 500,000 and the terms were extended for 5 years. We're in year 3, so we got 2 years coming. Present value of $1 for 2 years and that's the part that's weird. And sometimes students will say, I don't understand because we changed the terms to 3%. Why are we picking up 12%? And I tell my students when they ask me that, maybe you should think about becoming a member of the FASB someday, because there were members of the FASB who felt that you should use the 3% as the discount rate, but others felt that no, the historical rate was more appropriate. So we don't tell them, they tell us. I happen to agree that it should be 3%. But we got to do what they tell us to, right? So they tell us use the historical rate, which was 12%. And for the interest payments, because there's 2 of them, we have present value of an annuity, again at 12%. We pick up that factor. They add those 2 together, and on a present value basis, this is the present value of the future cash flows that, compared to the carrying amount of the loan, gives the creditor a loss. They set up the bad debt expense, they credit the allowance, and then they ultimately would go ahead and write off that that loan accordingly to bring it down to its present value. Okay. Question. Okay, good. So worthwhile to realize here that we have what? We have different treatment by the debtor versus the creditor. The debtor was taking what? Was taking a bad debt expense of $136.50, and the debtor was only taking a gain of $30,000. But they didn't want those debtors taking big giant gains, so they felt that this was a better treatment. Okay, good. Now you come over and let's take a look at extinguishment of debt. So what happens? I have issued some bonds, and really they could have put this up. Remember, guys, our first part, chapter 5, was all about bonds that we went through together. We were talking about bonds at that point in time. And I issued the bonds. The bonds were, say, 5-year bonds. And after a couple of years, I decided to call those bonds. And in the bond covenant, it will say that I have to call them at a certain price when I call them. Calling them means I'm going to pay off the debt early before it matures. 5-year bond sits out there a couple of years. I'm saying, hey, I'm going to go ahead and call this now. Okay. If that's the case, then we have to figure out what is the gain or loss on the extinguishment of that debt. Now you come over and we need to think about the reacquisition price. And reacquisition price, we've kind of already talked about how these calculations would work earlier, but reacquisition price is going to be called out as 102 or 95, for example. 102 means more than 100% of face. 95 means what? Less than 100% of face. Or they could say, hey, they get called at face. That would probably be kind of weird if it did, but it could do that. So if it's getting called at 102, you take 100,000 times 1.02, they're going to have to cough up $102,000 cash to call this debt. If they said 95, then they have to call out, pay out 95,000 to call this debt early. Now, what we'll do is we will compare that to the net carrying amount of the debt, and to calculate the net carrying amount of the debt, and it's going to probably be a bond that we're talking about. It's going to be the face of the bond plus any amortized premium, or, right, it can't be both, or minus unamortized amortized discount and minus the unamortized bond issue cost. Okay, so flashcard, how to calculate the reacquisition price, the net carrying amount, and then you're going to look at these examples and see that this is pretty easy stuff. Okay, so what happens? And they give us the information up there, guys, but I don't think for the sake of time here, we need to sit here and read through all that. The bond has a face of $1 million, and the problem told us to call that debt early we have to pay 101 of face. So if it's $1 million bond, you multiply that times 1.01, they're going to have to pay 1,010,000. Or step one, if you will. Now, what happens? Now I have to sit here and I have to compare that to the carrying value of the bond. And the carrying value of the bond is going to be the face of the bond, whatever that is here, $1 million, and then less unamortized discount and bond issue cost. If they had a premium, we'd add that, right? But since it's a discount and unamortized bond issue cost, we subtract that. That gives me a carrying value of $937,208. Now, sometimes students have trouble with figuring out if that a gain or a loss on the extinguishment. And the example I would give, let's say you owed $937,208 for your house. That was what your note was that was left on your house, right? And the bank said, well, just give me $1,010,000 and we'll call it even. Would you feel like a winner or a loser? You'd feel like a loser, wouldn't you? Well, wait a minute, I only owe you $937,208. That's the carrying value of that debt. And you're telling me I got to pay you $1,010,000? Well, of course, a bank couldn't do that to you, but for bond, it could say in the covenant, if you want to call it early, that's your price. And if the carrying amount is what is less than that price, that becomes what? That becomes a loss. Okay. Now you come over and you take a look and don't worry about the journal entry there, but you take a look and what if it's a gain? How would we calculate that? How would a gain work? Well, now they're telling us we have to call it at 96. And now they're telling us the face is $1 million. There's an unamortized premium. So we add the premium and that difference is what? That difference is going to be a gain on the extinguishment. Why is it a gain? Think again, you owe $1,052,421 on your house and the bank says, give me $960. You're going to be, yes, I just gained, right? Because you're getting to retire a debt for less cash than the carrying amount of that debt. Okay. Okay, good. And again, you don't need to get into that detail there of the journal entry. Question. Okay, good. Let's go ahead and let's take a look at a couple of these questions together, and then we will take a quick break. The reason I'm saying that, I thought everybody would have had their book by now, but since some of you didn't, I'm going to post up chapter 6. So you'll have the chapter 6 material available on Canvas, and then we'll jump into chapter 6 material after the break. But so we're going to go to break a little bit early, and if we get tired, we can take another one before the end. But let's go ahead and let's take a look at this question. Okay, guys, go ahead and make your selection. Okay. And okay, 73% of us got it correct. And that's okay. I guess this question can be a little bit of a mind twister. But I've got a couple of students choosing C and D. And I'm a little confounded by that because nowhere did we say that this would be part of comprehensive income. And we already talked about comprehensive income. And we say that comprehensive income are all changes in equity except what? Unless it's a stock issuance or a dividend that's paid out, right? Investment by owners or payments out to owners, which this is not that at all. So when you look at this, you can immediately eliminate C and D. Okay, nowhere do we say this comprehensive income. Now, this looks like a Becker written question, to be honest with you. And they give us all of this nonsense about it being unusual, infrequent in nature. That was the old language for extraordinary item, which no longer exists. And hello, old guys, this is in the past. Okay, forget about it, let it go. There are no more extraordinary items. Okay, so the fact that you'd even see a question that would bring in all that language is probably unlikely. Okay, but it's not comprehensive. So you saw a question like this on the exam, they might be interested in, can you figure out if it's a gain or loss, and maybe give you some other nonsense to make it a 4-choice question. Well, look, if the bond was issued at a discount and it's a 20-year bond, will it be at face after what? After what, 5 years here? No, it's not going to be back to face until the end of the 5 years, right? Remember, we keep coming closer and closer to the face value as we amortize that discount. Okay, so it's not going to be at face, yet they did what? They had to recall it at an amount that was more than the face amount, didn't they? So that means that they called the bond and had to pay for it, what, for more than the carrying amount of the bond, didn't they? That's what? That's going to be a loss from continuing operations. And this thing of what the price is that was quoted is irrelevant. Question. Okay, so most of us got that right, but that's one of those questions that you gotta kind of read through and twist your neck around a couple of times till you make sure you've understood what they're talking about there. Okay, all right, if there's no question on that one, let's go ahead and let's take a shot at question 2. Okay, guys, let's go ahead and wrap up your choice here. We're at about the 2-minute mark. Okay. All right, good. Let's go ahead and end the poll. And good, and good 90% of us that tried it. Out of the 12 participants in class, there's 3 folks that are maybe not trying this. Don't get me in the mode where I have to start calling out names. Okay, so everybody should at least try it. Even if you can't get it right, it's okay. You start to learn from attempting here in class, right? So when you're doing your homework, you're a little more familiar with the material. So as you're heading into your exam, you're feeling comfortable with this kind of stuff. Because this is a fairly easy question, although you do have to kind of read through some nonsense here, okay? But a lot of CPA exam questions are like that. I always tell my CPA students, you know, if you're building you get a desk from IKEA and you build the desk from IKEA, and after you're done, you look and there's a bunch of spare parts on the floor. You go, oh, I messed up. There's something's wrong. What is this other stuff that I didn't use? In a CPA exam question, there's almost always some junk left on the floor that you didn't need to answer the question, right? That's part of what they're doing. And the reason, frankly, that they're doing that, it's fair game on the CPA exam. Remember, you're studying for a license that will allow you to give an opinion on financial statements. They're really giving you a license to audit. And the thought there is, well, if I'm a client and I throw a bunch of irrelevant facts at you, are you able to sift through the important information in a timely manner to get to the right conclusion, right? So that's part of why they are allowed, or decide they're allowed, whatever the examiners, to do that. Now, we say that on July 31st, year 1, Dome issued $1 million, 10%, 15-year bond at par. A typical risk management strategy, which does not matter because we're not going to be calling this out as any kind of extraordinary, but whatever, and used a portion of the proceeds to call its 600,000 outstanding $1,000 face bonds at 102. Well, all that other stuff really doesn't matter much to me. All I need to know is, what did they pay to call these bonds? And if it's 600 bonds and they have a face value of what? $1,000 each. That means that the carrying amount of this, face amount, I should say, this debt is what? 600,000. And they tell me right in the question that it had a premium of what? 65,000. So I know I have to add in that premium, don't I? Okay, so I bring that in. So the carrying value of these bonds were 665,000. And they had to call them at what? They had to call them at 102. So we take the 600,000 times 1.02. That gives me what? That gives me the 612,000. Difference there is 53,000. And since I'm paying what? Less than the carrying amount of the debt, that is going to be what? That is going to be a gain. And thank you, examiners. I didn't even have to think through, is it a gain or a loss? Once I saw that 53,000, I knew that that's what I had to take. But again, if you're paying less than the carrying amount, that's a gain. If you pay more than the carrying amount, that's a loss. That's why I had to do flashcard. What the 2 key things is, do you know how to figure out the carrying amount? Do you know how to figure out what was paid? Difference is the gain or loss. Okay, question? All right, guys, we're going to take an early break here. Why don't we come back? I'm seeing that it's 5 till, so we'll come back. Let's make it, I'm always on that weird time here. So let's just make it, we'll come back at 6:05, I guess. So I'm going to give you a little longer for the break here. We'll come back at 6:05, and right, is that a longer break or a shorter break? Yeah, it's a longer break. So what I'm going to do is I'm going to post up here in a couple minutes the chapter 6 material to e-learning, so that folks that didn't get their book can download that and have that in front of them as we start in chapter 6. All right. Okay, guys, I'll see you in a little while. we'll go ahead and do take 2 on that. You can see the chapter 6 material there that you want to take a look at. And let's go ahead and jump into the chapter 6 PDF, which I just posted up. And we're going to, of course, start with the table of contents. And I am going to ask you, and I haven't unhid the recording yet for the leases discussion in chapter 5. In chapter 6, I'm going to ask you to take a look at that on your own. You can either watch my lecture or the pre-recorded lecture for the leases. Leases are about 5 points on the exam, but I think it is straightforward enough that you should be able to go ahead and take a look at that. And I'll post the announcement as to how far into the lecture you need to watch for that. It's about an hour or so, but I don't want us to get caught in not being able to cover some areas that I think you need more of my help on. And those areas, well, let me back up. Derivatives are about 2 points on the exam. You should watch the Becker recording for that. Again, light area could take us too much time. And so I'm going to ask you to look at that on your own. So I'll post up tomorrow where to watch up to for the leases discussion of my lecture, or you could watch Becker's lecture and then do watch Becker's lecture for the derivatives. So that the game plan for tonight for chapter 6 is to finish the rest of it. Okay, now foreign currency is about 5 points. And you look at that and you say, well, John, if it's only 5 points, why are you choosing that over, say, leases, which is also 5 points? Well, the reason I'm doing this is 2 reasons. One, maybe you haven't had an advanced accounting class. And if you haven't had an advanced accounting class, then you may not have had exposure to foreign currency. And so I think it's worth our time getting into that, whereas leases is covered in intermediate. The other reason is that I had a dream that some students got an exam question, a task-based simulation, in which they were asked to do consolidation, which is no surprise. We said that you may actually get a consolidation question on your task-based simulation. But in the particular one that students described to me in my dream, they said what was hard about it was a English subsidiary that we were consolidating into a US parent. And, you know, with tears in their eyes, they told me we couldn't figure out how to turn the pounds into dollars, and we were stuck because we had 2 different denominations there being used, 2 different types of currency being used, and I didn't know how to consolidate those. How to turn the pounds into dollars so that I could consolidate. So we're going to spend some time with that, because that could have what? That could have potentially a 10-point impact if it ends up being a task-based simulation, which are rolling in consolidation as well. So we're going to talk about that here in a couple minutes. And then income tax accounting is a 10-point area. So we're going to cover that together. So again, because we have fallen behind, I am putting a little more pressure on you to look at some of these lectures on your own. And I'm trying to have our time together be more focused on heavier, maybe a little bit harder to understand point values. Okay. Okay, good. So with all that, that means that we want to jump to the foreign currency discussion. So I don't know why I'm always trying to exit out of full screen to do that. It's best to do that in full screen. So you have your leases discussion, you have your derivatives. I'm asking you to look at the videos on those. And then we're going to go through the foreign currency here together. And I don't know why my full screen has become a thing where it doesn't let me fit the whole screen on, but I'm going to have to figure that one out. Okay, good. But let's go ahead and let's take a look at this module 4 here, foreign currency from chapter 6. Okay. Now, when you look, we're going to be looking at a couple of different things. Foreign currency transactions, very straightforward. I'm a US company. I have a transaction with a company in Mexico, and for that particular transaction, I'm going to have to make some adjustments to turn pesos into dollars. Not terribly difficult. We will see that when we get to page 41. So they kind of put that here first, not 14, John, page 41. We see that, you know, here is the first thing they talk about. Meanwhile, they don't get to it until much later on in the discussion. Okay. 1, 2, 3, 4, 8. Okay. Okay, good. Okay. 1 second. Just noting we had a little attrition here. Okay, all right, good. I just want to see what's going on there with that, but I'll get to that. I'll get to that here for a little while. Okay, good. All right, so you come over and that's going to come up in page 41. Now, when you look at foreign currency translation, okay, this is the situation in which we have a U.S. parent. It's almost always a U.S. parent on the CPA exam. I mean, it could be a foreign parent, but that is rarely, I've never heard of that actually being on the exam, but it is fair game, but I don't think they would do that. It's going to be a U.S. parent, and they're going to have to bring in a foreign subsidiary. Okay, and when you do that in the consolidation, and when you do that, you could use translation, but you could also use something called remeasurement. Okay, and we're going to talk about both of these methods, and then I have some flashcards up that will help you to know when you are to use the remeasurement process versus the translation process. But that's what happens when you bring a foreign subsidiary into the U.S. parent, okay, which is really what we're going to be talking about here first. Now, when you look at the exchange rates, you will use various exchange rates depending on whether you are using the remeasurement method or whether you are using the translation method. And it's going to depend on which item in the financial statement you're looking at. If you're looking at monetary versus non-monetary items, that will also govern which exchange rate you use. Now, sometimes students think that I'm telling you have to memorize exchange rates between pounds and dollars or something. No, they'll give you the exchange rate, but you have to know when you should use what exchange rate. And that's the thing that I'm going to ask you to memorize, whether it's the current or what. So when we look at these different rates here, and we first look at the current exchange rate, and current exchange rate is the rate for the current date or immediate delivery, or the spot rate is also called. So it is typically going to be what? It's typically going to be the end of year rate. And again, depending on whether we are using what, whether we are using the remeasurement method, translation method, which items on the financial statements we're looking at will determine which of those rates we should use. So flashcard that definition of current rate. Okay, now you look at some of these other ones, and let's look at the historical rate. Okay, and historical rate is the rate that was in effect the date for the acquisition of stock or the acquisition of the asset. Okay, and we're going to look at that. The reason I have you flashcard the definition of current, because they also call it spot rate, and so I don't want you to get confused. What is the spot rate? That's why I asked you to flashcard that. You don't have to flashcard historical rate. I think that's pretty obvious. Weighted average rate, okay, and the weighted average rate And when we talk about weighted average, it would be used for recurring transactions such as sales, okay? When something has occurred evenly throughout the year. And note that this often will apply to inventory / cost of goods sold. Okay, so they'll tell you that inventory is acquired evenly throughout the year, or if they tell you sales occur evenly throughout the year, then the related cost of goods sold must have occurred evenly throughout the year, right? Since there's a direct matching there between your cost and your sales, okay? Now, you come down, guys, in some of these rates that they're calling out. I'm not getting into them here because why don't you go ahead and flashcard that's for a transaction that occurred evenly throughout the year. And I just want you to put a flashcard. Remember, inventory cost of goods sold could also be affected by that. I'm not going through all of these because some of them are not relevant to our discussion. So I'm not sure why they're mentioning it here, but just take a look at reporting currency. Is the currency the entity ultimately reporting financial results for the foreign entity? And this is going to always USD, which is US dollar on CPA exam. Again, ultimately, think about what's happening here, what we're talking about. We are talking about what? Consolidation. We've got what? US parent, and they're pulling in the subsidiaries. Well, remember, ultimately, it's just what? The parent's financial statements that we're looking at in consolidation. And since it's the US parent, we will ultimately report everything what? In dollars. So the reporting currency is always going to be the US dollar on the CPA exam, okay? Now, when we look at the functional currency is the currency which is the primary economic entity, primary economic environment in which the entity operates, and it will either be the local currency or it could be the reporting currency. So let's say you have a US parent and they're looking at a company, a subsidiary that does all its business in England. Well, if that's the case, then what? The functional currency is going to be what? Is going to be the pound, because they're doing all their business in England, because that's where their primary business is. It's also what? The local currency. And then the reporting currency is going to be what? The US dollar in that case, okay? So that's how the functional currency would work. And then you come over and you take a look and they tell us that we will either have translation or we will have remeasurement, and we have translation when the foreign currency translation of the refund denominated in the functional currency to the reporting currency using appropriate exchange rates. So if we're simply going from the functional currency to the reporting currency, we will use translation. If we are going to have a situation, we will use the remeasurement when we will be going from the foreign currency to the entity's functional currency. And that's the case of the reporting currency is the functional currency. So now we have what? Maybe English company doing all its business in the US. And then if we have a 3-country example, then we will first have to remeasure and then we will need to translate. Now, I'm going to give you that example that I was showing you here in a couple of minutes that will kind of put this into English for you. I'll actually have an English company, but it'll put it in the English language for you so that you understand what the heck we're talking about here, and you'll be able to read through this a little bit easier. Now, you come over, and because we need to understand monetary versus non-monetary items, because that's going to govern which exchange rates we use in many cases, okay? Monetary items are things like cash. They are things that will not change as the price level changes. So just think about cash for a second though, okay? What happens? You have $100 in your pocket. You fall asleep for 100 years. You wake up 100 years later, how much cash do you still have in your pocket? $100, right? Okay, unless probably in a real case like that, you wouldn't even wake up with pants on, but whatever. Let's just pretend that you're in a cocoon somewhere. You're still going to have $100 at the end of the sleep, right? Okay, so that didn't change, even though by then $100 might be like 10 cents, right? Whereas what non-monetary assets, change with the general price level. So what happened? You bought a house in the Bay Area in 1974. You paid $100,000 for that house. That same house now might be worth $3 million. So as the price level changes, so does the value of non-monetary items. So they give you here some examples, but you can see cash versus what? Versus property, plant, and equipment being listed as non-monetary. Okay, so I think it is a good idea to shrink this chart down. If it's not already in your Becker pre-made flashcards, shrink it down so it fits on a flashcard. Have it there so that prior to your exam, you're kind of just refreshing your memory as to examples of what may be monetary versus non-monetary. Okay, question on that? Okay, good. So let's just go ahead then. And I think the best thing for us to do at this point is to go to the example. Now I'm going to come back to this table here in a second so that we can take the example that I have in English and then look at how it's talked about in what I call FASB speak, so that we're able to we get a problem and can understand what they're trying to say to us. So let's just go ahead. And those are, as I pointed out to you, on e-learning, okay? And don't worry that it says financial too, guys. I should probably retitle that file, but on Canvas, it's under on e-learning, it's under chapter 6, right? Okay, but let's just go ahead. Which one's which now? Which one do I want? This one first, okay? And let's just take a look at this. And I think, do I need to put it in full screen? Does that help at all? No, out of full screen, no full screen, exit full screen on that. Okay, good. I think this is probably the best way for us to look at this. Okay, you may have to move your eyes a little closer to the example to be able to see it, but let's just take a look to the screen to be able to see it. So we have a US company with an English sub, and it's doing most of its business in the US. Okay, now if that's the case, the US currency is the functional currency, and what? The US dollar is always the reporting currency. So when the functional currency and the reporting currency are the same, we use remeasurement. Functional currency, and this is a flashcard, by the way, guys. I consider this a flashcard. You should have this with your flashcard somehow so that you're reviewing this prior to your exam, okay? But the functional currency is the same as the reporting currency. This is what? This is going to be the remeasurement method. Now let's think about what's happened. A US company has bought an English subsidiary, but most of the business is being done in the US. So they probably have bought what? A supplier or something, and they're deciding that it is worth them to purchase the supplier because they're going to be importing some goods that they're probably selling in the US, right? Okay, so in that situation, they have considered that the remeasurement method. So remeasure English subs denominated in pounds, and in this case, we're going from the local currency, the pounds, to the functional currency, the US dollar, which is also what? The reporting currency. So it could also be articulated to you that way. The local currency is the pound, the functional currency is the dollar. What should you do? You should remeasure, okay? Now, rates to use, okay? And here's where it becomes important that you know whether you are using remeasurement or translation, because what? Well, it's important for a couple of reasons, but for your balance sheet, for your monetary items, use the year end. And we saw that that could also be called what? The spot rate. That's why I had you flashcard that, okay? For non-monetary items, use what? Use the historical rate. Now, inventory could be called out as a non-monetary item, but you could also use what? You could also have to use weighted average for inventory if they tell you that the inventory is acquired and sold evenly throughout the year, right? Okay. Now, when you look at our income statement accounts, hard for me to change color here, use the weighted average for revenue payroll, use historical rate for balance sheet related items like depreciation, cost of goods sold, unless, again, the problem tells you that what? Inventory is acquired and sold evenly throughout the year, then you're going to use weighted average for the cost of goods sold. And I'm going to show you how to calculate weighted average when we get to the numerical example that Becker has for us here in a couple seconds. Now, once you know that you're using remeasurement, you now have memorized, well, which rates do I have to use? Because the question will give you multiple rates and you know which rates to use for which financial statement line items, right? Okay, whether they're income statement or balance sheet. Then what? Then you sit there, and guys, when I say memorize, it may sound like I just asked you to memorize 52 things. And if it's monetary, use the year end. If it's not monetary, use historical, unless it's inventory and they told you they acquire weighted evenly throughout the year. For income statement, use weighted average unless it's related to a balance sheet item like depreciation, amortization, unless it's cost of goods sold, in which case you'd use weighted average if they tell you the inventory was acquired and sold evenly throughout the year. Now, the process, how are we going to actually do this process? I'm going to look at this here in a couple of minutes, but let's see, I guess I'll go to blue maybe. Start with the balance sheet. So you will first remeasure the balance sheet, and you will plug an adjustment to make the balance sheet balance to equal whatever you have determined the net income. Then you will take the net income to the income statement and you will plug the remeasurement gain, and it is part of income from continuing operations. Guys, don't worry about that idea mnemonic. That was some time back that we don't really use that mnemonic anymore. Okay, and we're going to go through the example as to how that will happen. But you will first remeasure using the appropriate rates to remeasure the balance sheet. You're going to have to sit there and you'll have to come up with a number that'll make the balance sheet balance. That plug goes to retained earnings, and that plug that you take to retained earnings to bring the retained earnings so the balance sheet will balance is then going to be what you determine your net income to be, and that will get plugged into the income statement. That plug is considered a part of income from continuing operations. Now, you come over and you look at the alternative situation here now, which is that we will translate. Okay, and we translate when we have a setup something like this. If I want to turn it back to highlighter, I guess. Is that highlighter for me? Okay, and I wanted to turn it to yellow. Okay, good. So we have what? We have U.S. company with English sub doing most of its business in England. Now, if that's the case, then we use the translation method. Again, let's think about what's happened. There's this subsidiary in England doing most of its business in England. And the US parent is looking over there and saying, wow, that looks like a really good business over there. I'm going to take that over. Well, now what's happening? They're not sitting there and they're not probably purchasing a supplier or something. They are simply making an investment in an entity that's operating primarily overseas. So if that's the case, then what? The English pound is the functional currency, and it is what? The local currency in that case. So US dollar is what? Always the reporting currency. So when the functional and the local currency are the same, and you have to go always to the reporting currency, the US dollar, then you translate. Okay, so you will translate English sub financial statements denominated in pounds, the local currency, to the functional currency, the US. The US dollar is the reporting currency. Now, because this has happened, because the functional currency and the local currency now are the same, we use translation method, and now they start to talk to us about different balance sheets. So notice for my balance sheet, I use what? I use the year-end rate, except for my common stock and my additional paid in capital, we use what? Historical rate. My retained earnings is simply going to be a roll forward. What does that mean? Beginning balance plus my net income minus any dividends, right? So that's how you'll calculate the retained earnings. For the income statement, easy enough. They tell us for everything on the income statement, use weighted average. Now, the process here, okay, we're going to stay consistent with the colors, I guess here. So go with the blue. Now we start with the income statement. We close net income to retain earnings, and we will plug a number to make the balance sheet balance. And that plug is part of comprehensive income. It is the F in our mnemonic puffer or whatever that mnemonic was that we used before, but it is part of comprehensive income. Okay, it is not part of our ordinary income like it would be with the translation method. Now, you come over to the second flashcard I've given you. Remember, there was two. And let's take a look at a three-country example. Now, I highly doubt that the examiners will give you a task-based simulation consolidation where they're going to have three countries involved or three denominations involved. But let's just take a look now at how it could look if it was three company now. And so now we have three country. We have an English company, and it is a subsidiary of a US company, and its primary market is Europe. In this case, the euro is the functional currency, the pound is the local currency, and the US dollar is always the reporting currency on the CPA exam. So first, we have to do what? Remeasure the financial statements from the local currency to the functional currency. But we can't stop there, because now we have to what? Then we have to translate from the what? From the euro now, okay? And we're going to have to do what? Translate from the euro, which is the functional currency, to the US dollar, the reporting currency. And guys, this question is no longer question 16. I'll show you a question that you'll do with that. Now, again, the remeasurement is what? Is part of continuing operations. That translation gain would be what? Or loss would be part of my comprehensive income. And I repeat, I'm not going to go through this, but I repeat the rates that you would use to what? Remeasure, the rates you would use to translate. Now, that hasn't changed. Now, I hope that we don't have the situation where we have three countries we got to deal with, but three countries, yeah, three denominations we have to deal with, but just in case you've got this flashcard too. Okay, now we've looked at that. Any question on that? Okay, if there's no question on that, then let's go ahead and go back to the textbook here. And we had sort of left it off here. Okay, and let's take a look. When will we use remeasurement? And let's see it in FASB speak. Okay, so when we talk about remeasurement, and here they're telling us that what? The reporting currency equals the functional currency, right? So we have what? English company doing most of its business in the US, right? Reporting and functional are the same. Okay, so what happens? The reporting currency is the functional currency, and the remeasurement method must be used when, and notice they tell us day-to-day operations of the subsidiary depend on the reporting currency. Well, in our little example, if the English company is doing most of its business in the US, then their day-to-day operations do depend on the reporting currency, the US dollar, right? Okay, so I'm just showing you the example that we talked about now in the context of more generic language that you might see in a question. Okay, now you come over and you look at scenario 2. Okay, and with scenario 2, we have what? We have the reporting currencies, the parent company. And now for the foreign subsidiary, the foreign currency equals the functional currency. So now the pound is the functional currency, English company doing most of its business in England. So what are they telling us? And again, FASB speak of what they may say to us, the foreign currency is the functional currency, and the translation method must be used when the foreign subsidiary is relatively self-contained and independent and operates primarily in local markets. Day-to-day operations of the subsidiary do not depend on the reporting currency. English company doing what? Most of its business in England use the translation method. And that triggers to you that we have on the flashcard I gave you, the process and the exchange rates that you have to use, right? Okay. Then what? Then we come over and we have what? We have the foreign subsidiary, the foreign currency. Then we have to go to what? The functional currency. And then we always go and translate. So we first remeasure, then we translate. Okay. So when the functional currency of the subsidiary differs from both the local currency and the reporting currency. So functional currency was euro, local currency was the pound, and reporting currency is always US dollar. The subsidiary's financial statements must first be remeasured from the local currency to the functional currency, from the pound to the euro, and then must be translated from the functional currency, now the euro, to the US dollar. Okay, I'm hoping that this last part doesn't happen. You know, that would be a little evil of the examiners to make you do 3 currencies through, but just in case you got it. Okay, now I've given you the flashcard of what exchange rates and whatnot to use. But why don't you flashcard what they're saying to you here at the same time so that you're also seeing it, and I'm talking about just these lower parts, because you've also, you know, I want you to have the words as to when you use remeasure translation, or first remeasure, then translate, using the language that you may see on the exam. Now, when you come down from this table, guys, for the sake of time, I'm not going to read through which exchange rates you should use for which financial statement line items, because I've already shown you that on the flashcard, right? So that would just be a repeat of what we just saw on the flashcard that I've given you. Okay, so if you want to read through that on your own, you can. I do not think it's necessary because I have that on a flashcard for you. Okay, so what we want to do at this point is go through this comprehensive example. And I think what you'll see, when, I don't know if it's comprehensive, but it's a good example of when to use translation versus remeasurement and whatnot. And I think what you'll like after you look at this is it's kind of fun. Okay, now one of the things that we're going to, you know, maybe I have a warped idea of fun, but it's not that bad. Okay, once you start to see it. Now, as we look at this, one thing that we have not talked about at this point in time is how to calculate this weighted average. So they just kind of give me the weighted average. And I think maybe they're thinking you already know how to do this, but I'm going to go ahead and show you how they came up with that number. Okay, since they don't ever really tell us that. Okay, so what happens? They have this situation. Let's just read through the fact pattern. Financial statements, a foreign subsidiary of Dollar Corporation, are shown at the end of the year, end of December 31st, year 2. And they tell us the 2 examples follow. First, translating using the local currency as the functional currency. And then they tell us, you know, what we should do when we remeasure, okay, is what they're using in the example. Now, they give us from December 31st, year 1 to March 31st, year 2. And we're going to be doing the translation, the remeasurement for year 2 here, okay? And so what happens? We're looking and seeing that the translation is 0.18 from whatever the local currency units are to the reporting currency, which is, of course, the US dollar. And that was outstanding for what? For 3 months, all of January, all of February, all of March. So we would take that 0.18 and we multiply that times what? Times 3/12. That gives me 0.045. And then they look and they show us, well, this new exchange rate was in effect from April 1st to June 30th. Well, that's what, another 3 months, April, May, June. So I go ahead and I multiply that times what? Times 3/12, and that gives me 0.0325. And then they give me, and they broke it out in these different tranches here. I reckon maybe the reason they would do this in different tranches, if a company was giving quarterly financial information, they might need the rates at the end of each quarter. But since the rate didn't change from Q1, Q3 to Q4 here, as this turns out, of course, you could take that 0.1 and multiply the whole thing times what? Times 6/12. They were different, then you use a different rate for those 2 quarters. But I think they wanted to slow down on this example a little bit. And so that comes out to 0.05 for that last 6 months, the last 2 quarters. That, guys, when you add all that together, that's how they got this 0.1275. And maybe you knew that already, but I just hate when there's all of a sudden a number thrown there and they're not showing us how they got it. Now, they tell us that inventory was acquired evenly throughout the year. Sales were made evenly throughout the year. So I know that I'm going to use what? I'm going to use the weighted average method, a weighted average rate, I should say, for my inventory, my cost of goods sold. And then they tell me that fixed assets were acquired by the subsidiary on December 31st, year 1. So I know that what? Well, I'm going to use that historical rate for those balance sheet items, depending on which method I'm using. Okay, good. Now you come over and you take a look, and this is a helpful example because remember we said, well, look, if you're using remeasurement, you have to start with the income statement and then you start plugging numbers. Did I say income statement? You have to start with the balance sheet if you're using remeasurement, and then you have to start plugging numbers to the income statement. If it's what? If it's translation, start with the income statement and then go to the balance sheet. And so I think you can see pretty clear on the screen, guys, the watermarks, okay, 1 and 2, that's telling you where you start, okay? So let's go ahead. I like to do remeasurement first. I mean, it's not really important because this is basically not saying that it's 3 different denominations, it's just 2. So you wouldn't have to first remeasure and then translate here because you're going to do one or the other because it's 2 currencies depending on whether or not the local currency is also the functional currency or the reporting currency is a functional currency and whatnot. So, but let's go ahead and take a look at the 2 methods, okay? And we start with the balance sheet with remeasurement. And when we start with the balance sheet, we go ahead and notice they're using what? They're using the current rate, okay? They're using that 0.1, which was the year-end rate there. They're using that, right? That was the rate in effect at December 31st. So they're using that for their monetary items, aren't they? Cash is a monetary item. So they go ahead and it's denominated what? In the foreign currency at 10,000 times what? Times the 0.1 here gives me the 1,000. They do that for accounts receivable. Accounts receivable is going to be what? Is going to be a monetary item. So we multiply that out and turn that into dollars. Notice for inventory, they used what? They used that weighted average. So they're multiplying that 95,000, coming over to the remeasurement column, 0.1275, turn that into dollars. For the fixed assets, they used what? They used the historical rate because they told us they acquired the fixed assets back then, right? So again, that's why it's important that you know which rates. Again, you don't have to memorize the rates. They'll give you what is the historical rate, what is the current rate, but you need to know which ones to use at the right time here, right? Okay, for depending on what method. So we go ahead, we extend that out. And when we do, we get the total assets are 63,653. And then we start doing the liabilities section again for my monetary items using the year-end rate. For common stock, they told us, or I put on the flashcard, use a historical rate. Now, when you do that and you add 3,400 plus 13,200 plus 36,000, you get 52,600. Does the balance sheet balance? Balance sheet ain't balancing right now. Does the balance sheet have to balance? Yes. And so what they did is they said, well, I need $11,053 to make the balance sheet balance. So if that's the case, if they just started business, that means the beginning balance in retained earnings is what? 0. They didn't talk about any dividends here, so I had to plug 11,053 to increase the 0 balance retained earnings to an ending balance of 11,053. That must be the net income, right? That's my net income. So I go ahead and I take that 11,053 and I say, well, if that was my net income, I'm going to report that as my bottom line net income on the income statement. And now I proceed to remeasure the other items on the income statement using the weighted average for the sales. Sales occurred evenly throughout the year. Therefore, what? My cost of goods sold uses the weighted average. For balance sheet related items like depreciation, I use the historical rate, right? And then I use weighted average for pretty much my other expenses that aren't related to the balance sheet. Now, when I do that and I sit here and I take my total revenue minus my total expenses, the difference between those two numbers is 4,199. In other words, they're saying, well, your net income should be 4,199. But I already told you that it's what? That it's 11,053. So what do? I plug a number in there. So the difference between the 11,053 and the 4,199 is that what? 6,854 number, so that the income statement works. That's reported on the income statement. That is part of what? That is part of income from continuing operations. Okay, now, one thing that I think worth pointing out here, in this little example, they assumed it was year 1 of the operations and they assumed that there was no dividends. The examiners are not bound by that, okay? The examiners may likely tell you that the beginning balance in retained earnings, okay, let's just put retained earnings at the top of this. They may tell you that the beginning balance was, say, and I'm just making this up, 56. They may tell you that the company paid a dividend of 3. Now, if I know that the ending balance in my retained earnings needs to be what? Needs to be 11,053. And the reason the ending balance has to be that number is because now I'm getting stuck in the situation where I'm writing near the page break, which is never smart. 11,053 is the ending balance. Then that means that I have to what? I have to add something. I have to add net income of what? Of $11,000. I'm doing my math right? Right? Minus the dividend would get me the 11,053. So now what? Now I'm saying that plug that I'm plugging into the retained earnings, I'm saying that's my net income. So now what? So now 11,000 would be the net income that would be reported up here, and my plug would change in this example by $53, right? Question on that? because I don't think the examiners are bound by saying beginning of the year, no dividends. If they made you do this, I bet you they would make you have some dividends and stuff. Okay. And a beginning balance retained earnings, but it's not that bad. You just analyze the retained earnings to see what the net income should be, and that's the number you take up and plug up into the income say is the amount of net income, and then that governs what your plug should be. Question. Okay, good. Now that's the remeasurement method. And you may get a problem that just wants you to do that. U.S., English subsidiary doing most of its business in the U.S. Simply remeasure, follow that process, use the correct rates. Now, if they're sitting there and they're saying English subsidiary doing most of its business in England, now we got to what? Now we got to translate. Okay. Now, when you look, and I'm going to erase these lines now because they're kind of going to be in the way. What you would do is you would go ahead and use the appropriate rates, guys, based on what the flashcard says, pretty much weighted average for what? For everything. I'm putting a big multiplication sign there for everything on the income statement. Then what? I go ahead and I have my net income, which is in this point now 5,354, and I take that 5,354 and I do what? I simply roll it down to the retained earnings. Now look, it's becoming 5,354 for my retained earnings because what? Because the retained earnings had a beginning balance of 0 and there was no dividend. But if it was a situation where there was a beginning balance and there was a dividend, then I'd have to consider that in figuring out what the amount of the ending balance in the retained earnings is going to be. The plug's going to be the same, but the ending balance of retained earnings would be different, right? It'd be beginning balance plus net income minus the dividend would give me the ending balance, right? So I'd have to do that analysis. Okay. But whatever the retained earnings ends up being, there it is, just like any situation. Take your net income, add it to the beginning balance of retained earnings, minus any dividend, that would be the ending balance of retained earnings. The reason the number is exactly the same here is because there was no beginning balance, there were no dividends, right? Then I go ahead and notice that pretty much for the what? For the balance sheet items, I use what? I use the current year-end rate, except for common stock, I use what? I use the historical rate. I do that, and notice my total assets is 40,800. If I add up my liabilities and my stockholders' equity, including my retained earnings at that point in time, I would get 57,000. Read my own writing. 57,954. Does the balance sheet balance right now? It does not. Right now, the balance sheet doesn't balance. Do we want the balance sheet to balance? Of course we do. So what do? We subtract an amount from the rest of the stockholders' equity to make the balance sheet balance. That is part of what? My comprehensive income. And in this case, they assume that the comprehensive income had no previous balance. If it did for other things, then again, you wouldn't just plug in the number that makes it balance that assumes it's a 0. You might have some other number you need to plug, but it's whatever number, including whatever the balance is in the accumulated comprehensive income needed to make the balance sheet balance. Question. Okay, so even though I think this is only a 5-point area, you can see why I wanted to spend some time with this, because let's face it, nobody wakes up in the morning and says, oh, remeasurement was translated, I got this, okay? So you want to be comfortable with this process, which most of it is what? Laid out on those couple of flashcards I gave you, okay? And then you can look at this example, and then in the off chance that you do get a consolidation where you're consolidating a foreign subsidiary into a U.S. company, you'll be in pretty good shape to work through that. Having said that, don't get stuck, guys. If you run into a situation where you're not sure what rates to use and you can't get things to work out quite the way you want them to, so what? Plug a number in there. They're telling you to plug a number, aren't they? So do your best to plug the number correctly in the place that it's supposed to be. You're plugging a number anyway, aren't you? So don't get all hung up on, oh, I can't get this thing to translate. So just put the number in there, plug it, and then move on to the consolidation part of it. And sin no more. Remember, it's what? Positive grading for what you do correctly. So if you mess up a couple things on the translation remeasurement, who cares? Keep going. Okay. Okay, but at least we give you a fighting chance with that. All right, now you come over, and of course we said individual transactions are a little more straightforward. Okay, and so let's look at this now. Now we're not talking about bringing in a whole foreign subsidiary and whatnot. Now we're talking about what? Just one transaction. Okay, just one transaction. How will we account for that when we have difference in the currencies? Okay, so a foreign exchange transaction gain or loss will result if the exchange rate changes between the time of purchase or sale and the time the actual payment is made. And it could also be or at year-end rate, because if we prepare for financial statement reporting end date, because we do what? We have to prepare our financial statements at year end, and if there's been a change, we're going to have to calculate the transaction gain or loss there. Okay, so let's take a look. That says or, not on, but or year-end rate. Okay, so when the actual payment is made or year-end rate, depending on what the question's asking me. So you'll see what I mean by that when you look at this example down here, because they have us do both of them. Okay, so Alinto company purchased goods on credit for 100,000 pesos. Alinto company paid for the goods on 12/1 year 2, and the exchange rates were as follows. Now they made the transaction on 12/1. We have a year-end rate, and then when the transaction is finally settled, they give us the rate at that point in time. Now notice that we first record the transaction using the transaction date rate, which is 100,000 pesos times the 10 cents gives me $10,000. I set up the, and it could be, if I was using the okay, perpetual method, it would go to inventory. I guess they're assuming the periodic method here, so they're using purchases, whatever. Okay, but whatever it is, that would go at that rate at that point in time. Now, what happens? By 12/31, the rate moved from what? Just looking back up, it moved from 10 cents to 8 cents. So we only have to give up 8 cents to the peso to settle this thing. So we've gained, haven't we? We don't have to give up a full 10 cents. We only have to give up 8 cents. So what happens? At that point in time, the difference is 2 cents per peso. So 2 cents times $100,000, we debit the account payable because we don't have to pay as much in dollars now to settle this. And we have a foreign exchange transaction gain. That gain, guys, has nothing to do with comprehensive income. That is a transaction gain that is reported as part of continuing operations. Now, what happens? By the time we go to settle that, and we're now in year 2, we are going to have, unfortunately, the exchange rates now have moved 1 cent not to our favor from 8 to 9. So now what happens? Well, now we're going to have to pay 9 cents on the peso. So we know that's the cash that's going out. We're liquidating the payable that would be standing at $8,000 at that point in time. And since we had to give up what? An extra $1,000 to settle this thing, that difference between the exchange rate at the end of year 1 and by February 1st of year 2 is a 1 cent difference. That's that $1,000. Okay. Question? All right, good. Let's take a look at a couple multiple choice questions quickly here, because we still got deferred tax to go, and I'm almost reluctant to try that, but we still have a full hour. I don't know if that's enough time. Hopefully it will be, but we'll see what we can do here. I may have to just get you through part one maybe, but we'll see. Okay, let's go ahead though, and let's take a look at the poll here. Okay, good. Let's go ahead and let's take a look at this one. And so I'm going to end the poll. And good, 75% of us got it correct. Okay, the answer here is B. But let's just take a look at this one. And we have what? We have part company, wholly owned German subsidiary. Schnell maintains its accounting records in euro. So the German subsidiary has its companies in euro. And what Schnell does most of its work, most of its branch, all of its Schnell's branch offices are in Switzerland. It's functional currency. So we have what? We have a difference between the functional currency and the what? And the local currency. And so if that's the case, we're going to have to, and then we have what? We have a reporting currency that's different. And I know that because they give me what? A number for translation as well. But I have to first what? I have to first remeasure, don't I? Okay. And so that remeasurement gain, and they just tell us that the remeasurement gain is this 7,600, and that remeasurement gain is reported where? On the income statement, isn't it? It's part of continuing operations. So you look at that question and it sounds like this complex, Holy Toledo thing. And all you would have to remember is the remeasurement gain is what? Income statement. The translation gain or loss is part of what? Other comprehensive income. And they would be reported in two different places. In this case, we have a remeasurement gain shown on what? Shown on the German subsidiaries financial statements. And then what? Then we remeasure from the German subsidiary to what? To Schnell to Park. That's going to be what? That's going to be another comprehensive translation gain that's part of comprehensive income. So there is no zero. there is no what combining them. So you could have almost turned this into a 50-50 just by remember that they're reported in two different places. Question? Okay, good. Let's go ahead and let's look at this one. Okay, guys, I'm going to go ahead and end the poll. And good, most of us got this correct. Almost everybody picked D. There was one choice for C, but let's just go ahead and take a quick look at this. Get the poll out of my way here so I can see the question. My mouse is doing a little number on me here. This way. Okay, good. All right, let's go ahead and recenter this. And let's just take a look. And on September 22nd, year 4, Yumi purchased merchandise from an unaffiliated foreign company for 10,000 units. Foreign company's local currency. On the date, the spot rate was 55. Yumi paid the bill on March 20th, year 5. So the transaction was year 5. They don't pay it until year 4, when the spot rate was 65. The spot rate was 70 at December 31st, year 4. What amount should we report at the end of year 4? Again, that's why I didn't want to just focus on the settlement like the book had kind of just said that in the text. Then they did show us the two different things, one at settlement, one at the year end. And so in this case, we have to do, well, we have to pick up that year end. So the year end is what? Well, when we did the transaction, it was 0.55. And then by the end of the year, it had changed to what? 0.7, and they're asking me at year 4. So, I mean, really the challenge here is making sure you know what date they're asking you. And so that means that it has moved against us, what, 0.15 times what? Times the 10,000. So that's going to come to what, a $1,500, and it's a loss. Doesn't matter because, oh, I guess they told us it was a loss, you know. Some questions might have you say gain versus loss, right? So you'd have to know, well, if the rates move against me like this, that's a loss. Okay. All right, how are we feeling? Got some energy left for deferred taxes, or you want to wait till next time?
I feel good.
What do you think, guys? I need to hear. I know Michael's ready.
How many points?
Well, it's 10 points. I'm going to go through it with you either today or next time. I'm not going to leave you hanging on it because it's a 10-point, but I'm just feeling like you guys might be just feeling like the tidal waves are hitting you here. Okay. All right. Well, let's go ahead. Let's try it. See how we feel. It is, a little bit tough area here, but I think we can maybe get through the whatever it is, the module. What is it? Module 6 here. Module 5, I guess, first, and then we won't get into module 6. That we will put to next time. Okay. So let's try to do that. Okay, good. Now we come over and basically we're talking about intra-period tax allocation, which is a little annoying, really, in that we report our income from continuing operations. Okay, and we report income from continuing operations is what? We have operating income, right? Operating items. Then we have what? Non-operating items. That gives us our, and then we have what? Then we have tax, and that gives us our net income. Remember we talked about that way back when you were young, back in F1, okay? And then we said, well, discontinued operations and change in accounting principle, which is an adjustment to the beginning balance of retained earnings of the earliest period presented. That's all what? That's all net of tax, right? Remember we did a little side calculation of the tax effect and reported those on the income statement net of tax. So all that's saying to you is, hey, you report your tax as a tax expense, is there subtract from your income before taxes, and then you subtract your tax expense, and then you report your net income, right? Okay. All right, so that's all we need to say there about intra period. Where we're interested here, guys, let's not belabor something that we've already learned. We're interested in inter-period tax allocation, okay? Now this comes because what, and we've talked about this in here a couple times, that there's difference between what FASB says we should do to prepare our financial statements versus what the IRS tax code says that we should say to submit our what? Our tax return. So what's going to happen? If you look at our net income using the GAAP rules, it's different than our taxable income using the tax code. And so what FASB has come down and said is, well, look, what you're going to have to do is understand these differences, and you're going to have to look at those differences and see, and if they are permanent differences, they will have no effect on any deferred tax asset or deferred tax liability. If they are temporary differences, meaning that they will reverse at some point in time, and that's where most of our discussion is going to center around here tonight, we're going to have to what? We're going to have to report a current and deferred portion of our tax expense, and we're going to have to report a deferred tax liability or a deferred tax asset. Okay, that's where we're going with this stuff. Okay, now you come over, and I just want to see something, guys, for a second. Okay, that's fine. Somebody wanted to tell me that they clicked the wrong one. Sorry, when a chat comes in, then I get a whole thing that blocks what I'm doing. So I just want to look at that. Okay. All right, good. Now you come over, and it's worth noting, guys, because it's worth easy points on the exam. The current portion of my taxes is whatever is payable to the IRS. It is the simplest thing in the world for the CPA exam. Take what they're telling you is the taxable income, multiply it by the tax rate, boom, you've got the answer for the current portion. That's simple, okay? What gets a little bit more interesting is what the future year taxes that can generate a deferred tax asset or deferred tax liability. Okay, so when we look at this, then we're going to start to have to look at those differences and see how that generates a deferred tax asset or liability. And then the question may ask us to separate our tax expense as to whether it is current or deferred. The current is easy. The current is always what? The current is always whatever the tax return is. But if they ask us the deferred portion, now we're stuck analyzing that difference a little bit, right? And then we have to know whether we should use the current rate or the enacted rate. Now, what's going to generate those deferred tax assets and liabilities are going to be temporary differences. So temporary differences result when there's something that enters into pre-tax GAAP financial income in a period before they enter into taxable income, or something enters into pre-tax GAAP income in a period after they enter into taxable income. So since there's going to be a reverse at some point in time, that's a temporary difference, and we are going to have to know how to analyze that difference in determining whether we have a deferred tax asset, liability, and our deferred tax expense, if it's a deferred tax liability that has changed, or if we're talking about a deferred tax asset, then there's going to be a tax benefit. Now, you come over and you take a look at permanent differences, okay? Permanent differences are things that will never reverse. Hello, obviously by the word permanent, okay? And these are things that enter into GAAP income, but will never enter into taxable income. For example, interest on state and local bonds is never taxable at the federal level. And every now and then I roll my eyes when I hear people pontificating saying, what the federal government's going to do is it's going to start to tax state and local bond interest in order to raise additional tax revenue. If Congress tried to do that, then the Supreme Court would come in and say that's unconstitutional, because the Constitution says that the federal government can pass no law that interferes with the revenue generating activity of state or local government, which that would be considered a law that does that. And so that would be struck down, pretty quickly in the courts. So that will probably always be the case. Okay. Now, what happens? You could have something that enters into taxable income, but never enters into pre-tax GAAP financial income. And we're going to study this probably next time. For example, the dividends received deduction is something that is only relevant to tax. Okay. Now, you come over and they tell us that permanent differences do not affect deferred tax computation. Flashcard that. Temporary differences, when you permanent differences, when you see those and those are in a question and then they ask you about the deferred tax situation, you ignore those. You do not enter them into the calculation. Okay. Now, the temporary differences, which we've already talked about, temporary differences do affect the deferred tax computation, okay? And these temporary differences affect future periods, and they will require either a liability for future taxable amounts. That means that what? I have an expense that GAAP is telling me I should take this period, but what? But I'm not able to take that until strike that. I haven't taken it yet for GAAP purposes, but I'm able to do what? Take it for tax purposes. But later on, what will happen? I won't be able to take that for tax purposes, even though I'll be taking it for GAAP purposes. That's going to create a liability because what? Later on, I'm going to have to pay higher tax. It is an asset if there's an amount that what? The GAAP is saying I should take now as an expense, but I won't be able to take it until what? Until later for my tax purposes. That is a future deductible amount. That's going to be a deferred tax asset. Okay. Now we come over and you take a look down here at accounting for interperiod tax, and we talk about our current income tax expense benefit, okay? And that is what? That is always going to, or we could have a deferred income tax expense benefit, okay? current income tax expense is equal to the income tax payable or refundable for the current year as determined on the corporate tax return. That's easy, guys. That's the check that's going to the IRS. That's always the case. Okay, that's a piece of cake for us. Okay, the deferred income tax expense or benefit, and just come over and take a look. They tell us deferred income is equal to the change in deferred tax liability or asset account balance from the beginning of the current period to the end of the current period, which they call the balance sheet approach. Now, there are very few questions that actually have you doing that part, okay? But let's just take a look at this table, okay? And we have what? We have the current tax rate, okay? The current tax rate, and we multiply that times what? Times our taxable income on the tax return. That's the current liability. That's the amount that's going to what? To IRS. Then we'll look at the temporary differences. What are the differences between what GAAP is saying should my be my net income versus what the IRS tax return is saying is my taxable income? That difference, and we only worry about temporary differences, gets multiplied by the enacted future tax rate. And what happens? That can create a deferred tax liability. And if it creates a deferred tax liability, we will add it to that current tax rate to come up with the total tax expense. And the question could ask me the total, which means I'll have to add those two together. Or the question could just ask me the current, or the question could ask me the deferred. Now, what happens if this generates a deferred tax asset, meaning that what? I'm going to have future deductible amounts, and that's the result of this temporary difference. Then I'm going to subtract that from the current liability to come up with the total asset, and the total expense. And in that case, then what? Then if they ask me the current, that's going to be the same number. That's easy. That's IRS. If they ask me the deferred tax asset, then that would be whatever the enacted tax rate is times that difference. And if they ask me the total, I'm going to subtract that deferred tax asset from that current liability to come up with the total tax expense if they were to ask me that in the question. Okay, now let's go ahead and let's look at some numeric examples that are coming up here and see how we will apply these different terms. Now, again, guys, we take a look at permanent differences, and income tax expense for a period is calculated only on taxable items. For example, tax exempt interest is included in financial income, but excluded from computing income tax expense. If that's the case, there is no deferred taxes for those because they do not reverse themselves. Okay. Now, I have limited concerns with tax law affecting the FAR part of the exam, okay, except when it comes to some of these permanent differences. So I am going to ask you to flashcard examples here of permanent differences, okay, just flashcard these. We've mentioned the tax exempt interest, okay, but you can see certain life insurance premiums and whatnot would not be included in income for tax purposes, but they would for GAAP purposes. Fines are not deductible for tax purposes, but they would be considered for GAAP purposes, okay, and so on, okay. Flashcard all of these, guys, just flashcard, okay. Note that we come over and now we look at these permanent differences, okay. Just let's look at this with the numeric example. And they tell us that I have a difference. I do have a difference between what? My taxable income and my GAAP income. When they say income statement, they're talking about GAAP here, right? So there is a difference. And so your instinct is, well, since there's a difference, I got to account a deferred tax asset liability. But then when you look at this, these are what? These are permanent differences. So there is a difference, but it's not going to generate what they used to call them temporary differences. Yeah, a temporary difference. They still do call them temporary differences. It's not going to generate a temporary difference. Therefore, there is no deferred tax asset liability. Whatever it is that I'm going to send to the IRS, that is also what I will report as my income tax expense. Okay. So where the action lies is what? In the temporary differences, right? That's really where most of our fun is going to be here. So you come over, and I just want to take you straight over to this passkey, okay? Because some of this stuff starts to get it just goes on a bit about what generates these temporary differences. And I think that you're better off just knowing what the permanent differences are. Let's not cloud our brain. And so unless we're seeing one of those things as a permanent difference, then we'll know it's a temporary difference, okay? But let's just take a look and see how, and this is a passkey that I do like, a deferred tax liability, this DTL, is when future accounting income is going to be greater than future tax accounting income is going to be greater than future financial accounting income. That's telling you what? Someday I'm going to have to pay more tax than what GAAP is telling me I have as net income, right? If it's a deferred tax asset, they're telling you that what? Hey, as far as the accounting standard, the future tax accounting income is going to be less. So you're going to have to pay less tax in the future than what GAAP would say maybe you should be paying in tax based on what your income is. So I'm going to have an asset. Okay. Now, when we look at deferred tax liabilities, let's just look at that and see how that mechanically works. Okay. And we have this Stone company began operations on year one and reported $225,000 of financial income for the year. Stone's year one tax depreciation exceeded its book depreciation by what? By $25,000. Now you look, and that is how they're coming up with this $200,000 taxable income, right? Because if I had GAAP income of $225,000, but my depreciation for my tax purposes was $25,000, then my taxable income is only $200,000, right? Because I took an extra $25,000 depreciation, right? Okay, so at that point, I know the difference is what? Is this $25,000? Okay, so you can see it there. They just tell you the difference. And they tell me that the tax rate for year one and years after is 21%. And they tell me that in year two, the book depreciation exceeded the tax depreciation by $25,000. But let's deal with let's just deal with year one first. Okay, then we'll look at year two. Okay, so when you look at year one, you have what? You have this $25,000. This is a temporary difference, right? Because it's going to reverse. They tell me that it's going to reverse in year two. And if they asked me the current tax, that would be what? That would be, thank you, God. Yes, that's my income tax payable to the IRS. They could ask me that. They ask me the current portion of the tax expense. That's a piece of cake, right? If they just ask me that. If they ask me what? They ask me what is the deferred portion of the expense. It's the difference times, and the current rate and the enacted rate are the same because they said it was the same in the future. So I still use that same rate. They didn't even give me a second rate. So that is what? That is a deferred tax expense. And if they ask me the deferred tax liability, well, that matches the deferred tax expense because that's an amount I think I'm going to have to pay out in the future when this difference reverses. Now, note that when the difference reverses, what happens? Well, then I go ahead and I have a debit to the deferred tax liability because I'm going ahead now and I'm paying that. And now what? Now, because my book income is what? Is sitting there, and it is an amount that is now going to be lower than my tax return. Now my tax return is saying 225 and my GAAP statements are saying 200,000. I'm going to lower my income tax expense for year 2 because it's supposed to be for my financial statements reporting purposes, because it was supposed to be reporting net income of 200,000 here. Meanwhile, I already paid that tax, so now I lowered my tax expense for that next year. So for that next year. So this is on the income statement. This obviously being a liability is on the balance sheet. Question.
Yes, I have a question.
Mm-hmm.
So who determined the deferred tax rate? Is always a giving, or is we have to do certain
Well,
calculation?
they'll give us the rate, okay, but sometimes they might give you additional rates that you might have to know to ignore, or you might have to know which rate to use for what. For example, if this problem told us that the enacted, let's say they said the current rate was 30%, which it wouldn't, but let's say they said it was 30%, but it said the enacted rate was 21%, that would be relevant to when it would reverse. For the current year, you'd use 30%, and for the deferred tax asset or liability, you would use the enacted rate, because that's the rate that'll be in effect when this thing reverses, right? Okay. So they'll give me the rates. I don't have to memorize the rates or anything, but I would need to know when to use it's either the current rate or the enacted rate. Sometimes we'll see a flashcard, passkey flashcard in a minute. They'll give me some other words like proposed rate and that kind of thing. Always ignore those. It's either the current rate or the enacted rate, and they would have to give us those in the question if they're giving us a couple different rates, or they may just say the enacted rate and the current rate are the same, in which case you just use the one rate.
Okay, thank you.
Okay. Okay, good. Now you come over and let's go ahead and let's look at a couple questions. Let's apply that understanding right now. So I'll give you the poll here. Okay, guys, I'm going to go ahead and end the poll. I'm only seeing a few responses, and I'm a little concerned there because it kind of means to me maybe we've gotten tired and have tuned out of what's going on here. Look, the reason I say that is this is as easy as it gets for deferred taxes, because they told us what they told us taxable income is 140,000, and we have said that what that's the easiest because they asked me what amount should report as income tax expense current portion. The current portion is always what you're going to send to the IRS, right? Taxable income times the 0.21 gives me, what is it, 29.4. That's it. They asked me the current portion. That's what I'm sending to the IRS, right? Question? Okay. Okay, good. Now you come over to your taxable income times whatever the rate is in the current year. Okay, now same facts, but now they're asking me about deferred tax. So let's look at that one. Same facts. Now they're asking me about the deferred portion. Okay, guys, I'm going to go ahead and give you a little more time. I called that out a little early because I started seeing a good chunk of responses, but I'll give you a little bit. Well, I think that's good. Let's go ahead and do that because we're kind of waiting for maybe one person. So let's just go ahead and let's do this one. Okay, so what happens? Okay, 73% of us got this right, okay, but what we need to do now to get the deferred tax liability using the same fact, now we need to analyze the differences, right, between the pre-tax income and the taxable income in order to come up with the deferred, they told us deferred income tax liability here. But the hard part is I got to figure out whether or not something is a temporary or a permanent difference, right? But when I look at this, they tell me non-taxable interest received on municipal securities, that is not going to enter into the calculation at all, right? I'm going to ignore that or whatever because it is a permanent difference, okay? And the fact that they even helped me by calling it what? Non-taxable, right? Again, telling me that's a permanent difference. So now I start to analyze the temporary differences and what? Long-term loss accrual in excess of deductible amount. So I have what? I have a $10,000 amount that I am going to be able to deduct later when I presumably sell that security, right? That's when they'll let me take that. But I'm thinking, well, that's going to happen later. So that's going to generate, if it was by itself, it would generate a deferred tax asset. But then we have what? This other side that is saying depreciation of financial in excess of financial statement amounts. I'm getting to take a deduction now that I won't be able to take later. So that's going to create a liability, right? So I have to net those two out. That gives me this 25,000 subtract here. That means that I have a net negative what? 15,000. Again, they only gave me one rate in this question, so I multiply that times the 0.21. That's how we got the 3150. The correct answer was C here. Now, let me ask you a question. What if there was a third question here that said, what is the total tax expense? Could you answer that? You would take what? They didn't ask that, but you would take
Just add 'em
31,
together.
huh?
Well, you can just add them together.
Yeah, good. The 3150 plus the 29.4, right, is the total. And I have seen questions where they do that. Okay. Okay, good. Now you come over and you take a look at deferred tax asset. And now what's going to happen? Now we're going to have what? Future taxable amounts. Now, the thing that comes in here that makes this a little bit of a pain, if I may use such a term, is that the potential is that we will not get to take that future deduction because we may not have income. Well, we'll get to take the deduction, but if there's no taxable income, then there is no benefit, right? So what they require us to do is take a valuation allowance. It is more likely than not that part or all the deferred tax asset will not be realized. And so we have to take a valuation allowance. And basically what's happening here is there's going to look and say, well, you guess what? You're not going to have income in future years. So there is no benefit. So don't take the, you're going to have a valuation allowance against that deferred tax asset. Okay. So this gets a little confusing because they, get all up in our face talking about the valuation allowance, which by the way, you should flashcard that. But then the first case, there is no need for a valuation allowance. And then the second case, they'll take the same facts and they'll tell you that there is a need for a valuation allowance. But let's take a look. Black company organized on January 2nd, year one, and had pre-tax accounting income of 500,000 and taxable income of 800,000. So what's happening? I'm going to pay the tax on something now to the IRS that by my GAAP purposes, I shouldn't have to pay tax. So GAAP is saying you're actually prepaying that, right? So that's going to generate a deferred, I should say, tax asset. Okay, so the enacted rate for all years is 21%. Serena, some problems will show you a different enacted rate. If that's the case, you'd have to use that different enacted rate. And they tell me the only temporary difference for this 300,000 is for product warranty cost, of which 100,000 will come in year 2, 100,000 will come in year 3, and 100,000 will come in year 4. Now, initially, that doesn't really matter. We take the total difference of the 300,000 times the 21%. If they ask me how much is the current portion, that's easy, like we saw in that problem. That is whatever we're reporting as taxable income on the tax return times the enacted tax rate. If they ask me the deferred portion, it's the difference times that enacted tax rate. And then that's going to be, let's just make sure we're clear because this gets a little funky. The deferred tax asset is what? Income statement. The current portion of the tax expense is what? Income statement, right? Okay. Then what? Then we have the income tax payable. That is what? That is going to be, of course, the balance sheet. That's the amount that we're going to be sending out. And it's probably a current liability because we'll probably be sending out to the IRS pretty quickly. And then the what? The income tax benefit deferred. That is what? That is the income statement is essentially saying what? You have lower tax than what would be implied for what you're sending into the tax to the IRS. So our total tax expense now is going to be what? Now it's going to be the 168 minus what? Minus the 63,000 here, or this what? This 105 is the amount that would be the total tax expense of 105,000. So it's minus the asset when you have an asset that's been increased or created in this example. Now, when you come over and the point of the valuation allowance, now when the company pays the warranty cost of 100,000 year two, the company will take out, we're not quite yet to the valuation allowance. The company will take out 21,000. That's that 100,000 for year two, because now they've used up part of that deferred tax asset, because now they're actually able to take the deduction for tax purposes. So they go ahead and they debit the income tax expense 21,000, because they're saying, well, that's not really an expense for GAAP purposes. So your expense really should be based on a higher net income number of a higher 100,000. And you have now used up some of your deferred tax asset, that 21,000. And then it'd be 21,000 in year three and 21,000 in year four, assuming we're actually able to now take these warranty costs. Now, what happens in sort of, they kind of, bury the lead here a little bit, because the point here in this whole discussion, I think, was the valuation allowance, right? So what happens? Let's say they determine, you know what? We may not have taxable income in years 3 and year 4. Well, if that's the case, then we're never going to really get to take that deferred tax asset for years 3 and year 4. It's 21,000 per year. So that's 42,000 that we have to set up a valuation allowance for, because we will not necessarily be able to take that. So they would still go ahead, guys, and take the full 63,000 deferred tax asset, but now they set up a valuation allowance of 42,000. That's a contra to the asset. So now the asset is just showing net the 21 that we think we'll actually get to realize in year 2. Notice, easiest part of this question, current income tax expense is whatever's the taxable income times the enacted tax rate. That's the amount that's payable. Okay. And then we have the deferred tax benefit of 21,000. Before, the deferred tax benefit was it was the full 63. But notice we're saying, no, we're only going to be able to get year 2 amount. So that is going to reduce our tax expense for the deferred tax benefit. And instead of putting the entire amount on the income statement as deferred tax benefit, we took the remaining 42 and used it as a contra against the entire deferred tax asset that we've set up. Question? Okay, good. I'm not going to bring in how permanent differences. We've talked about permanent differences. They do not affect. And so for sake of time, we're going to stop, because we only have 9 minutes left and there's really not much more that's added to that. So in the 9 minutes, I thought there was another question here, but apparently not. And I don't want to start module 6 here, because we won't be able to finish it. It's 9 minutes. It's not enough time. So I'm anticipating that we will pick up here, but any question before we adjourn?
So does that mean a sample number 5 is not important? So we don't need to study that as sample?
You can study it if you want to, but again, all it's doing is it's bringing in permanent differences, and we have to know to ignore the permanent differences. And after that, it's more of the same.
Okay, got it. Thank you.
Of what we already talked about. Okay. Question. Okay, guys, good work. We will finish up module 6 pretty quickly. And then when we start getting into chapter 7 next time, I'm going to think about that. There is a potential that I'm going to just jump us straight to chapter 8. Since we got a little time, let's talk about that actually. I'm looking at chapter 7. Table of contents. And I know I don't have it up here, but we have stockholders' equity, stock compensation, earnings per share, statement of cash flows. I look at that and even though statement of cash flows is heavy on the exam, are you guys pretty comfortable with statement of cash flows, preparing statement of cash flows, or you want to go through that?
Can we go do that, please?
You do want to go through it?
Yeah, maybe next time. Yes.
Okay, so what we'll do next time then is we'll finish this up, obviously, and I'm going to really try to get us through stock compensation, earnings per share, and statement of cash flows. I'm not going to go through stockholders' equity part 1, part 2. So if you want to, you can start to look at that, stockholders' equity, and then we'll go to stock compensation, earnings per share, and since you want statement of cash flows, we'll do that. That'll be next time, and then we won't get to chapter 8 next time. I highly doubt that, but we'll keep fighting the good fight to get through this stuff, okay? But I will not go through modules 1 and 2 next time. I think you guys can figure that stuff out by watching the videos and stuff, okay? And leases is still on your list, right? So I will give you a message tomorrow as to where to watch my lecture for leases. You can watch that, or you can watch Garrett Iralinto, or, Bill and Bob, whoever it is that's doing those. You can watch them and for that, or you can watch my lecture, and I'll tell you where it ends. Nick, I'll put that up tomorrow. Okay, guys, good work. I know that's a lot. This is the far part of the exam. It is wide. It is wide, but we'll keep fighting to get through it, okay? All right, guys.
Okay.
See you next time.
Good night.
Thank you.
Thank you. Have a good night.
Bye-bye.